You are looking at the scene of the action this hour. We are, of course, awaiting the Bank of Japan's policy decision, widely expected to be a rate hike. And based on past patterns analysed by Bloomberg, we've taken it this far. The BOJ may announce it just after 12:30 p.m. Tokyo time. That's about 11:30 a.m. in Hong Kong, 2:30 p.m. here in Sydney. It's right now 2 p.m. This is Insight with me, Paul Allen, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, Asian equities rise as cooling US inflation data backs the case for Fed rate cuts, calming tech jitters and also supporting stocks. The slowdown, though, in the US inflation comes with some credibility issues due to the lengthy US government shutdown. One economist calling it Swiss cheese data with a lot of holes. As the BOJ gets set to hike rates, we'll analyse the decision from the economic and investment perspectives. Former Assistant Governor Kazuo Momma is with us, along with Rogers Investment Advisors Ed Rogers. And as the RBI helps the Indian rupee make a bit of a rebound, we analyse the risks to its comeback with the CIO at ASK Private Wealth and Standard Chartered's Head of India Economic Research. All right, let's take a look at how markets are tracking ahead of that critical Bank of Japan decision. A lot of green on the screen. This is more to do with what we saw out of the US a little bit earlier on. US inflation, well, the CPI numbers came in showing the lowest core CPI increase in 4 years, although that comes with a big asterisk next to it. The amount of, well, they're calling it Swiss cheese data, the amount of holes in it was quite impressive due to the government-inspired shutdown. But we are seeing broad-based gains across most major indexes that we're tracking. The CSI 300 better by half of 1%. Similar story in South Korea. The Nikkei, meanwhile, powering ahead by 1%. Not a lot of change to the yen. Very much rain-bound at the moment. Well, the focus today is on Tokyo, where the Bank of Japan is widely expected to raise its benchmark rate to the highest level in 3 years, and this is a sign of growing confidence in a stable inflation target. Japan's key inflation gauge for November held at 3% for a second straight month. Markets will be watching closely for any signals on the pace of further rate hikes next year as the central bank navigates policy normalization, while the Prime Minister, Sahay Takaichi, pushes ahead with heavy borrowing to fund her stimulus plans. All right, let's get market insights now with Janet Rilling, Senior Portfolio Manager at Allspring Global Investments, which manages more than $500 billion in assets. Janet, obviously got to ask you the question of the moment. I mean, look, we're not expecting any change from the Bank of Japan today, but we're expecting an increase from the Bank of Japan today. So used to saying no change, but where are we heading next is the key question, because the pace of increases has been very slow.
Yeah, we, like the market, expect a 25 basis point hike here today, and that's really based on the economic data that we've seen. It's supportive of normalization, and economic confidence is strong. As we move into 2026, likely that the BOJ will want to slow things down, probably leaning more hawkish, but not in any rush to raise rates higher.
Do you think, considering inflation's pretty strong there, that, not, strong by historical standards, there is a case for the Bank of Japan moving a little bit faster on tightening, because this is the first increase since January. It's really moving at a crawl, right?
It is a slow pace. I think there's a number of crosswinds that will need to be absorbed. There certainly can be a case for them to move a bit quicker, but as data unfolds, particularly regarding global economic data and the impact to their economy, given exports as well as tariff pressures, I think there could be some reason for restraint.
So how about your outlook for the yen as well? That's been parked in that range between 150, 155. I mean, we are obviously anticipating a rate increase today, but when it comes to the commentary, Do you anticipate you're going to hear anything that might move the currency out of that range?
I think being range bound is the likely base case. However, if there's increasingly inflation pressure, I would lean towards more of a weakening trend as we look forward to the next, call it 1 to 2 quarters.
What is your outlook for yields in Japan as well? Because it feels as if every time we have a JGB auction, there's a lot of nervousness in the market, and then when it actually happens, it goes off quite well. But where's the demand coming from? Where do you see yields heading in 2026?
Yeah, we would expect continued upward pressure on yields. We think some of that will come from issuance that's going to be required to fund fiscal stimulus and just overall increasing government debt levels. Also, when we look at Japanese yields, we would expect more curve steepening. In other words, the front end being a bit more anchored, but the long end moving up a bit more.
Do you anticipate CPI in Japan remaining elevated, or and I'm thinking particularly in terms of the amount of fiscal stimulus that the Takaichi government has signaled coming in 2026? What does this mean for CPI? Do you think it's going to cloud the thinking at the BOJ?
I think that the amount of stimulus and that being a key focus is a risk and will lead to upward pressure on the inflation metrics as we move forward here.
Look, I wonder if we can talk a little bit about some of the other central bank news that we had today. Well, it wasn't really central bank news, but it's going to impact the thinking at the Fed. And that was that CPI report. Shows the lowest pace of increase in core inflation in 4 years now. But how much confidence do you have in those numbers, considering it was impacted by the shutdown?
Yeah, so on the face of it, it was an encouraging number, and the U.S. markets responded favorably to it. But as you have noted, the integrity of that data is in question, given the lengthy government shutdown and the delay with which it was released. So certainly no one number, we can't put too much weight on any one number. And I think given the questions around the integrity of the data, this one in particular, we have to be more cautious on. However, on the margin, I do think it is positive in that it came in cooler than expectations.
Well, the following month, we should get a more clearer picture. What are you expecting those numbers to show?
We expect that inflation, as we look out into 2026 in the U.S., to remain elevated and sticky at these higher levels. It wouldn't be surprising to us for it to remain in that kind of 3% area, and that will cause difficulty for the Fed in balancing what they're trying to do with rates.
So in 2025, we did see a Fed that was moving much slower than anticipated. Do you think we might see a repeat of that in 2026?
Our expectation for the Fed is that they will lean more dovish into 2026, given the change in the makeup of the committee. Clearly, we're going to get a new Fed chair, and that Fed chair will likely lean more dovish. But that said, because that doesn't happen until well into the second quarter, we wouldn't expect much movement until the latter part of the year. Our expectation would be for some additional rate cuts as we move into the second half of 2026.
Do you have any concerns about Fed independence?
I think that the makeup of the Fed does provide checks and balances, but we're also aware that the appointee for the chair will likely be someone with more view towards the dovish camp. But there is a number of other participants who vote, and that does provide some checks and balances in terms of the independence.
What's your growth outlook for the U.S. in next year?
Yeah, our expectation is for U.S. growth to come in between 2 to 3%, with it more likely to run a bit hotter than cooler. We've seen really impressive results out of corporate America working its way through the tariffs throughout 2025, and we think the momentum is building into 2026. We see a fair amount of stimulus coming through, whether that's fiscal stimulus, monetary stimulus. And then, of course, there's the CapEx cycle, which has been accelerating, and we'll expect that to also impact the growth.
More stimulus, more CapEx, does that potentially mean more inflation?
It can, and that's why, at the outset, I mentioned that our view is for inflation to stay elevated and sticky, and that's where we arrive at kind of that 3% area as we look into 2026.
Well, there's another wild card here as well, and that is, of course, US politics. I mean, we've got the midterms coming up towards the end of next year, but also more imminently, the potential risk of another shutdown at the end of January. How is that factoring into your thinking?
Yeah, in terms of politics, we do think that is going to be a story in 2026. We do think the first half of the year sets up for a better market environment, given the economic data and more of the stability. But as we round into the second quarter, uncertainty about the midterm elections and the potential for the House to flip could really lead to increased volatility, given it would lead to more policy uncertainty.
All right, Janet Rilling of Allspring Global Investments is sticking around. We'll talk a little bit more about some of the investment calls, movements in bond markets as well. But staying with rate moves for the moment, the European Central Bank left policy settings unchanged for a fourth straight meeting, with inflation in the region hovering around target. ECB President Christine Lagarde spoke after the decision.
The economy has been resilient. It grew by 0.3% in the third quarter, mainly reflecting stronger consumption and investment. The pattern of services-led growth is likely to continue in the near term.
Meanwhile, the Bank of England lowered rates to a 3-year low in a narrow vote. Governor Andrew Bailey told us room for further moves next year is limited, and the central bank will face closer calls on its decisions.
Well, I've been very encouraged by the progress that we've made on inflation. I've been saying for some time that we had this, what we called hump up this year. I thought it was going to come down, and it has. And the good news is it's actually coming down a bit faster than I think we thought it would. I'm particularly pleased because there's been an easing of food price inflation, which is really very important. I mean, all inflation is important, but we know that food is salient. It's very salient, and of course it hits those on lower incomes a lot as well. I think now that we're on a path where we'll probably be around this level for a few months, but we think that come the spring, April, May time, we should see another quite sharp drop and take us, I hope, to around target. So we're going to come back to target sooner than we thought. So that's encouraging. All of this is very encouraging. And for me, certainly, it was a strong basis to cut today. It's the sixth cut we've made. Now, looking forwards, I do think we'll continue to have something of a gradual downward path. We'll have to judge the evidence, as you know, at every meeting. We'll come back for the meeting at the end of January, early February, and do that. The calls do get closer, but because as we come down, we will approach a level which is going to sort of, in a sense, maintain inflation. It's not going to be too hot or too cold, if you like to borrow that phraseology. It's very hard to know exactly where that level is, but we will approach it. We're approaching that level. We must be approaching that level in a sense mathematically. So the calls will become closer, and I would expect the pace of cuts therefore to ease off at some point. But I'm not going to judge exactly when that is because it's too uncertain at the moment.
And that is the Bank of England Governor Andrew Bailey. We have plenty more ahead. This is Bloomberg. Let's get to some of the top tech stories that we're tracking. TikTok says it has signed deals to create a joint US venture, majority owned by American investors. An internal memo from CEO Xiao Chu tells employees that agreements have been made with Oracle, Silver Lake, and MGX. Oracle shares jumped in after-hours trading on the news. The new venture will operate as an independent entity that will control data protection, content moderation, and algorithm security in the US. The deal is expected to close in January, but Chu says more work needs to be done before then. Chinese regulators have also yet to say whether they'll approve the deal. OpenAI is reportedly aiming to raise up to $100 billion to fund its next big push in artificial intelligence. The Wall Street Journal reports the round could value the company at $830 billion if it hits the target. The fundraising comes as investor excitement around AI starts to cool. OpenAI has already secured major deals, including $30 billion from SoftBank and $1 billion from Disney, and it may tap sovereign wealth funds next. The company says it needs massive capital to build advanced models and stay ahead of rivals like Google. Well, Janet Rilling is still with us, Senior Portfolio Manager at Allspring Global Investment. Janet, thanks for sticking around. I just want to pick up on that AI theme in terms of OpenAI potentially approaching sovereign wealth funds. Do you expect to see more of this kind of thing? Because as the CapEx needs just keep piling up, where's the money going to come from?
Yeah, the AI super cycle is certainly showing no signs of letting up, even though some of the investor sentiment seems to be coming off the highs. As we listen to recent earnings calls, there's really been no evidence that they're looking to slow down. And that does raise the question, with all this AI-driven CapEx, where will it be funded? Tapping sovereign wealth funds is one avenue. Within the credit markets, there is concern about how much debt will be year 2026.
Sorry, I just need to interrupt you there because we have got the moment that we were all waiting for. It is the Bank of Japan decision, and BOJ has expected raised rates by 25 basis points. The overnight call rate now 0.75%. The decision unanimous, 9-0, and in fact, leading up to this decision, all of the economists surveyed by Bloomberg also expected the rate to go up by 25 basis points. A few other headlines coming in. The BOJ saying Japan's real rate is at a significantly low level. The Bank of Japan will keep raising the rate if the economy and price outlook is realized. It will raise rates in line with economic and price improvement. But accommodative conditions are needed to keep supporting the economy. So the BOJ judged it appropriate to adjust easing for the price target. We've got the Nikkei rising following that BOJ rate hike. Now, I do just want to divert now to another guest that we have standing by who has spent 35 years at the Bank of Japan, including serving as an assistant governor. Let's get to Mizuho Research and Technology's executive economist, Kazuo Momma. Kazuo, I know you've not had a lot of time to digest those headlines coming out of the BOJ, but the headline decision, very much as anticipated. I just wondered if you could give us your reaction to that off the bat.
Yes, as you mentioned, today's decision has been well telegraphed since the December 1st, Mr. Ueda's speech. And actually, the decision was not any surprise to anybody. But at the same time, a little bit surprised in the statement is that the usually statement does not include the policy principles going forward. But actually, this time around, a statement paper actually add one additional paragraph that is say about the interest rate is still very low, significantly low in terms of real rate, and also BOJ is going to continue raising interest rate in a gradual manner. That kind of thing has never been seen in the first statement, but it is actually there today.
You mentioned the policy principle going forward missing in the headlines so far. Do you anticipate that might come up in Governor Ueda's press conference later? And what sort of answers do you expect to hear around that?
Yeah, actually, usually that final statement, final paragraph of the statement is usually referred to by Governor Wheeler in the press conference this afternoon. But actually, that paragraph is put forward in the statement this time around. I think this is indicated that the BOJ is trying to make a lot of effort to convey their guidance of the monetary policy going forward, so that market people will not be confused by the first headline of the BOJ today.
Janet, I just want to bring you in here as well and get your initial reaction to what we're hearing from the Bank of Japan. Is there anything that stands out to you so far, particularly in terms of where we might be headed next?
Yeah, I think a lot of what has come out here is quite in line with what market. Yes.
I'm sorry, please continue, Janet.
Hi, can you hear me okay?
Yes, please carry on.
Yeah, so, what we've heard today so far, I haven't dug into the details yet, seem largely in line with expectations. Again, as we look forward, it would expect continued upward pressure on rates in Japan.
When you say continued upward pressure, I mean, where is the potential ceiling? How many increases would you expect to see in 2026, and what would be the cadence of those? Where do you see the neutral rate?
Yeah, in terms of increases, again, not expecting a rapid pace, but in terms of increases, maybe a couple more within 2026. Over the course of the year, timing is a bit uncertain.
Kazuo, I want to take it back to you if I can. I mean, you are a former Bank of Japan assistant governor. That decision today, as I mentioned, unanimous, 9-0 in favor of lifting rates by 25 basis points. I mean, you've sat around the table. Can you give us an idea of what might have been discussed at that meeting and what the tone of the conversation might have been like?
Well, I think the main focus of this meeting is that what kind of information the BOJ will talk about in terms of the forward guidance or the future prospect of the BOJ's policy going forward. And the one obviously important factor around that is that how strongly the price is going to move up in 2026, 2027. Today's CPI data, which was revealed right before the meeting, was 3.0% year-on-year, which was in line with the expectation. But actually, the underlying trend of inflation is still probably below 2%. So how quickly that underlying trend of inflation is going to converge around 2% is one of the discussion points this meeting. So I think the Takata-san is actually dissenting on the view about the inflation outlook. So that might indicate that how hectic the discussion might be in this meeting about the future prospect of inflation.
Yeah, talk to us a little bit more about the inflation outlook. How do you see that unfolding? Because today's numbers that we received earlier this morning came in bang on line. Do you think that we're going to see CPI continuing to track the way it has been?
It has been, but actually how to interpret what has been in the price front is really actually a sticking point in the discussion. Because on one hand, headline inflation is really strong, around 3% today, but a lot of the upward pressure has been coming from food prices and energy prices. So once those price pressure will fall out, the underlying trend of inflation might be revealed as astonishingly low, actually. So I think that's the very focus of the discussion of price outlook going forward. In my view, the December print and also February meeting next year is going to have some kind of the non-linear drop in the CPI inflation on the headline basis that will converge around 2%. So how far it could go, stop around 2% or even deeper in the low level below 2%, I think that would be still something we don't know yet.
Look, there's also fiscal stimulus coming from the Takaichi government. How will that be factoring into some of the BOJ's deliberations?
Of course, it is to some extent taking into account the discussion of the price outlook and the inflation outlook. But at the same time, in my view, that the fiscal stimulus of the Takaichi administration might be interpreted by the market as a little bit exaggerated way, because the size of the, for example, fiscal supplemental budget actually is not really big. I mean, it is to some extent big, but at the same time, it's not really surprisingly big. And also, the stimulus to the economy is probably 0.2 or 0.3% on the year GDP basis, and the inflation impact might be relatively limited. So I don't think you have to really overvalue the stimulus, size of the stimulus from the government. So I think that would be around the view of the BOJ in the policy board members.
Also connected to the stimulus, obviously we might see a little bit more debt needing to be issued. So what's your opinion on what we might see in terms of bond issuance from Japan? Where do you think yields might be heading?
Yes, bond issuance is in line with the expectation, at least reasonable range. Actually, it's not really increasing so much. Compared to last year, for example, combined with the initial budget and supplemental budget, JGB issuance is actually less this year than last year. So I don't think there's any spooking factor with regard to the issue of the JGB. But at the same time, there is increasing pressure of inflation and the underlying trend basis, and also the pressure of the currency weakening the yen. So that could actually translate into higher yield of JGB. But still, you have to remember that current level of JGB yield is only 1.92% level, which is still significantly low compared to, for example, Germany bond yield. Germany actually has a very excellent fiscal condition, but still a AAA paper, still 2.8, 2.9% range, and the JGB is only 2%, or less than 2%, so still very low. So there is a lot of room for the JGB yield to move up, even without any fiscal stimulus or further issuing the JGB. Just reflecting fundamentals, I think there is a room for going higher.
Do you have any concerns about the amount of debt that is building up in Japan? And I'm thinking particularly in terms of the debt to GDP ratio.
Well, actually, the GDP ratio has been around more than 200% of GDP for almost 10 years or so. So you should have been worried about that level 10 years ago, actually, if you are really worried about that. If anything, actually, for the last 3 or 4 years, debt GDP ratio has been declining. That's what Takaichi-san said, and that is true. So I don't think there is any clear reason why we have to be worried about debt level now if you did not worry so much about the debt level 10 years ago.
All right, well, we're just going to check in on Japanese markets as they do reopen from lunch. Ahead of the open, we were pretty much higher by about 1.1%, but we're seeing a big jump in the Nikkei now better by about 1.5%. A lot of those gains very broad-based as well. Just a couple of areas that are in the red, one of them consumer discretionary, not performing so well. Financials better by 1.1% now. So I want to take a look at the yen also. That has softened a little bit off the back of this decision, now 156.07. Kazuo, Momma, I do want to get back to you on the state of the currency at the moment. The yen range bound, really, at between that 150, 158 level. Where's the path of travel from here?
Well, I think there is a chronic pressure for a weaker yen because the interest rate in Japan is still low even after today's hike. And also there is a we shared view that the U.S. economy is going to be resilient going forward. So I think that is the fundamental around the currency market. So that's why I think the currency movement is fairly range-bound. So if anything, I think any surprise in the U.S. side or any fiscal spook coming from potentially next year from Takaichi administration, those two things could be potential game changer, but I don't think there is any imminent element that could move currency really dramatically.
You mentioned earlier that there was no mention of policy principle going forward. Also, no mention of timing either. One assumes that Governor Ueda is going to take a lot of questions about that in the press conference as well. So, where do you see the pace of rate increases heading from here in Japan?
Well, Governor Ueda in the press conference this afternoon probably doesn't tell any specific cadence of the policy trajectory going forward. There's no dot chart or something like that in Japan. He probably referred to the willingness of BOJ to just continue raising rates at a gradual pace as economy improves and inflation pressure going to converge around 2%. My view is that around about the same as the average view of the market. Probably I think the BOJ will continue raising rate at pace of around once every 6 months or so. So maybe 1 or 2 rate hikes 2026 and 1 more in 2027 and reaching the level of 1.5%. I think that is the most likely view at this moment. But actually so far really conspicuous fact is that actually all of the decision of the hike of the BOJ coincided with the phase right after the sharp depreciation of the yen, including this time. So I think the exact timing of the decision next year is also likely to depend on how currency market is going to evolve.
That's an interesting point. Do you feel as if we see another sharp depreciation in the yen? Could that bring the timetable for rate hikes forward?
Yeah. For example, as I mentioned earlier, U.S. economy is surprisingly strong the first quarter of next year, and the yen is under the pressure toward 160, maybe February, March, or April. I think in that case, BOJ is likely to put forward the rate hike in March, April. If the other thing happens, for example, deceleration of the U.S. economy is more pronounced than many people think right now, and Fed might be cutting aggressively interest rate in the lower territory, maybe BOJ has to wait until end of next year.
We have had a very slow pace of rate increases so far, as we've been discussing. Do you feel as if there was an argument to maybe speed things up a little, or has the BOJ got the pacing just right?
Well, I think this is about right. The reason is that Japan's real economy itself is not that strong. Consumer spending has been lackluster, while investment is clearly improving, but at a moderate pace. So overall, real GDP is hovering around 0.5% growth, which is very low, even historically speaking. So I don't think there's any clear reason for the BOJ to rush in a rate hike cycle in terms of the impact on the real economy. So only thing BOJ is now continuing raising interest rate is that the concern about the possible upside risk to inflation most likely coming from the exchange rate deepening the depreciation. So that's why I think that the BOJ's hike every time actually coincides with the depreciation of yen timing.
You mentioned the real economy is not particularly strong. Can you give us your outlook for growth in Japan over the coming quarters?
Well, actually, the third quarter was negative, minus 2.3 or something like that. Obviously, the fourth quarter that will come back to positive territory, but probably not compensating enough for the negative growth in the third quarter. I'm sorry. So I think the overall the trend growth is somewhere between 0.5 or 1%. So it's not really fantastic. Of course, continue to recover, but not that fantastic.
Look, I mentioned a minute ago when markets reopened that we're seeing a broad-based rally in the Nikkei at the moment, with the exception of just a few sectors, the most obvious one being consumer discretionary. So look, as we've got an environment of rising rates, levels of inflation that Japanese consumers are not used to, where do you see consumer sentiment heading in Japan?
I think consumer sentiment is now gradually improving. The reason is that the headline inflation, as I mentioned earlier, is going to rapidly decline over the next 6 months. And the wage growth is continue to be around the same level going forward. For example, right now, nominal wage growth is around 2.5% year-on-year increase. And this level of increase of wages is likely to continue based on the information available so far from labor side and the management side with regard to the next wage spring negotiations. And the inflation, as I mentioned, headline term is going to decline from 3% to around 2%. So sometime early next year, wage growth is going to be higher, is going to become higher than the inflation rate. So far, real wages has been in a negative territory by year-on-year basis, but next year, real wages is likely to be in positive territory. That could support consumption to some extent next year compared to this year.
All right, Kazuo Momma, former Bank of Japan Assistant Governor, thank you so much for joining us today with your time and your really excellent analysis. That's much appreciated. Let's take a look at where markets stand. In the meantime, I did mention we are seeing the rally pick up a little bit of steam in Japan. We're up a little bit more than we were before the lunch break and before the BOJ decision. The Nikkei now up higher by 1 1/3%, and that rally, as I mentioned, very broad-based. The best performing sector, communication services and IT. Utilities and materials lag. Consumer discretionary is pretty soft as well. The other asset that moved, of course, the Japanese yen, 156.07, so starting to weaken again. The Bank of Japan saying in its statement that real interest rates are expected to remain significantly negative after the change in policy rate. Accommodative financial conditions will continue to firmly support economic activity. So if you're waiting for further tightening, well, you might want to continue waiting a little bit longer. Take a look at some of the other assets that are moving on that board. It is a mostly positive day across the Asia Pacific because the other piece of key data we got out earlier was the US CPI numbers. It's been described as a Swiss cheese read, full of holes because of it is affected by the shutdown that occurred towards the end of the year. However, encouraging in that it did show core CPI at a lowest pace of increase that we've seen in 4 years. The Fed's Austin Goolsbee described the data as encouraging. It wasn't exact words, but that was certainly his sentiment. So the hopes of further Fed easing building, and that gave a tailwind to US equities, and we're seeing that propelling many of the markets in the Asia Pacific higher as well. We have the Kospi better by 2/3%. Hong Kong's Hang Seng Index better by 1/2%. Just seeing crude continuing to lose a bit of steam as some of those geopolitical concerns that we're adding to some of the supply pressure begin to back off a little, and the narrative about the glut starts to resume. But there at the bottom of your screen, the headline of the hour. Everybody saw that coming. The BOJ raising the overnight call rate to 0.75%. So we got that 25 basis point increase in rates from the Bank of Japan as everybody expected, and that decision was also unanimous. Right, let's get to some more top global stories that we're following. Canadian Prime Minister Mark Carney says a deal to lower US tariffs on sectors such as steel and aluminium is unlikely in the near term. Instead, those talks may be rolled into broader negotiations around next year's review of the US-Canada-Mexico trade agreement. Canada has been hit particularly hard by the tariffs due to its reliance on the US export market. President Trump has signed an executive order moving cannabis into a less restrictive federal category and a potential major shift to the legal and commercial landscape for the plant. The order instructs the Justice Department to move cannabis to Schedule 3 for drugs with accepted medical uses and lower abuse potential. Marijuana is currently in the highest class alongside heroin and LSD.
I want to emphasize that the order I am about to sign is not the legalization, or it doesn't legalize marijuana in any way, shape, or form, and in no way sanctions its use as a recreational drug. It has nothing to do with that.
U.S. police say a man suspected of last weekend's shooting at Brown University has been found dead at a storage facility in New Hampshire after taking his own life. Let's bring in Bloomberg senior editor John Harney now with more on this. So, John, tell us about the latest and the circumstances that led to this discovery.
Paul, as our colleagues Miles Miller and Greg Ryan report, there was a remarkable conclusion to two manhunts regarding shocking crimes at two prestigious universities. Brown University in Providence, Rhode Island, where last Saturday a gunman shot 11 students in a campus building and killed two of them. Then on Monday, a professor at MIT was murdered in his home. And it turns out that the person responsible for both these crimes is one and the same, according to federal authorities and authorities in Providence and Boston and state authorities as well. The motive is as yet unclear. However, there are connections. The suspect who was found dead, as you pointed out, in a storage facility in New Hampshire, went to school in Portugal with the professor, the MIT professor, and he was a PhD student in physics at Brown about 25 years ago.
You mentioned that we don't have a motive for this yet. One assumes investigators are continuing to look into this. Are there any leads at the moment?
Oh, there are many. I mean, this, as I used to say in my police reporting days, this was the result of old-fashioned detective work. A witness in Providence came forward and told the police that about someone she had interacted with after seeing videos that had been distributed to the media of someone who they thought might have something to do with this near the Brown campus. That led to a rental car that had been rented, leased in the suspect's name, and after that, they knew who they were looking for, and that led them to New Hampshire. Now, as far as motive, again, we really don't know. The suspect was last known to live in Miami, Florida. And why he would shoot students in a classroom who were studying for final exams and then go kill a professor near Boston is one of the things that the authorities are looking at right now.
Yeah, still a lot of unanswered questions in this case, and I'm wondering to what degree has that been hampered by, there's a lack of security camera footage, isn't there, which seems extraordinary considering the size of the campus.
Yeah, so this was an older building on the campus, apparently, so there wasn't any security cameras. However, as the president of Brown pointed out tonight, the suspect had some familiarity with the campus quite a bit, and I believe, as I understand it, had taken classes in that very building. So he knew, he wasn't a stranger to the campus at all, even though he was a student quite some time ago. And of course, this was very frustrating because unlike in a lot of these cases where these mass shootings, the suspect either kills himself right away or is caught immediately, this person took precautions, apparently, though not enough, fortunately, and was able to escape, at least until tonight.
All right, Bloomberg senior editor John Harney with the latest developments on that case, the shooting at Brown University. Right, let's get you to some live pictures out of India. It is the listing ceremony in Mumbai for ICICI Prudential Asset Management. That's about to get underway as India wraps up a sizzling year for IPOs with another potential blockbuster. I'm going to bring you a little bit more on that as well, including the company's official start of trading. I want to take a look at the Indian Open also. We have got a couple of idiosyncratic stories to watch in India as well. There's been a change in policy when it comes to nuclear energy. Any private investor showing interest in building nuclear reactors in India now can, with a change to the law allowing private ownership of nuclear energy. We're seeing some tailwinds for Indian equities at the moment. The Sensex higher by 0.4%. Nifty Bank Index a little bit slower there by about 0.2%, but follows on from the broader theme that we're seeing across the region today. This risk-on sentiment, one presumes, being driven by the encouraging CPI data we had out of the US, even though that was, as I mentioned, likened to Swiss cheese due to the number of holes in it, inspired by the US shutdown. Okay, we'll bring you the latest on that ICICI Prudential AMC debut in a moment. You can see those live pictures in Mumbai. We have that and plenty more ahead. This is Bloomberg. Let's check in on crude prices. It looks like normal service is being resumed. Prices hitting lower again. We did see a geopolitically inspired bump earlier this week with the U.S. Armada off the coast of Venezuela. Also, not a lot of progress on Russia-Ukraine trade talks. Not trade, what am I saying? Peace talks. Trade on the brain. But we've got prices now declining again as glut concerns continue to pressure prices. For more on this, let's get to Stephen Stapczynski. Stephen, those geopolitical pressures that I mentioned seem to have reversed somewhat. Is the world thinking more about oversupply again?
I think the world can't stop thinking about oversupply. I think it's on everyone's lips. You know, we had a huge big take story about the incoming glut and really where it's coming from. And it's a story of supply. And when you read that story, the analysts, the traders, the people are saying prices could go lower. The only thing kind of keeping us in that $60 range for Brent appears to be that geopolitical risk, that war premium that we have from the ongoing war in Ukraine, and also what Trump is saying about Venezuela. Even though Venezuela isn't a huge supplier in the grand scheme of things, it does add a level of risk to the market. But right now, we're looking at an oil market that is facing increases from major suppliers almost across the board. You've got OPEC Plus increasing supply through much of the year. You also have the U.S. supply, which is going to potentially hit a record this year and then continue kind of that level for next year maybe. And then on top of that, you have other countries that you wouldn't normally think of as suppliers also boosting their oil output. You've got China, which is producing essentially as much oil as Iraq, which is enormous. I mean, China's still a big importer, but they're developing more of their own domestic resources. You have Argentina developing their shale oil resources as well. They're requiring less supply from other countries and looking to even export some of their oil and gas, specifically gas as LNG maybe later this decade. So we're entering a market, especially next year, that is oversupplied. And while we do have these geopolitical events kind of kicking around that might increase prices one day, it does seem that the trend is oil prices are going to go lower.
Stephen, it begs the question, which of these big producers can produce supply at the lowest cost?
Well, that's a very good question, because when you look at OPEC, for example, oil prices are below where they need to balance their budget, right? I think you would often hear $70, $80 for some of these Middle Eastern countries for Brent. We're below that. For oil majors as well, you've got big producers out of, like Shell and others that need oil to also be higher to balance their portfolio. I think one thing to look at specifically is what happens with shale drillers, because they're the ones who are going to be able to more nimbly take on and off supply.
Stephen, I just want to interrupt you briefly, get viewers across some more news out of Japan. We've got the 10-year yield now rising to 2%. This is at a level that we have not seen since 2006, and it does, of course, come in the wake of that Bank of Japan decision to lift rates by 25 basis points to 0.75%. That is the highest level we've seen in 30 years. Still pretty low by global standards, but it's certainly moving markets in Japan at the moment. Yields rising across the curve, but that 10-year now now punching through that 2% level. That's something we haven't seen for getting on for 20 years. All right, Stephen, I just wanted to get back to you now. You were talking about who can produce at the lowest cost, the pressure that must be being felt on some of these OPEC countries' bottom lines. Well, what's OPEC going to do in 2026? They've already signaled a pause for the first quarter to wait and see what happens, but then what?
Yeah, I mean, certainly, I think the question is, will they continue this pause? So the pause is through the first quarter. So that's just a quarter of the year. What do they do for the last 3 quarters of the year? And also, are they going to increase adding barrels to the market? Do they want to continue capturing market share at the expense of cost, at the expense of keeping their budget kind of underwater? Or are they going to go the opposite way, which is start to kind of reduce supply? They've done that before in the past. Doesn't seem to be Saudi Arabia's strategy at the moment. Of course, things can always change, but the big question will be, what's Russia doing, right? Because Russia's that one wild card where if there is a Ukraine peace deal, then potentially you have the United States pulling back some of the sanctions that they had on Lukoil, on Rosneft. You could see more of their supply entering into the market kind of uninterrupted, even though a lot of it still is going to India and China. Without the war risk, without that happening, you could really see prices fall. And then that goes to OPEC saying, are you going to also be reducing your output? That will be something that they're likely going to have to discuss if that happens. There are a lot of ifs in that statement, but I think going forward, a lot of eyes will be on OPEC on how they react after the first quarter.
All right, Stephen, thanks for your analysis there. Stephen Stapczynski leads our Asia energy coverage from Singapore. He's going to join us in the next hour as well to talk about that policy change that I mentioned about nuclear energy in India. As we leave you, let's take a look at how yields are performing across Japan. We've got the 10-year punching through that 2% level for the first time since 2006. Still to come, veteran money manager Ed Rogers joins us live to react to the BOJ decision, also to give us his outlook for markets in Japan and beyond. Also a look at what lies ahead for India's embattled currency in 2026. Those conversations in a moment. This is Bloomberg. Welcome back. You are watching Insight, and there you see some live pictures from the Bank of Japan, where the big story of the hour, Bank of Japan lifting rates by 25 basis points to 0.75%. These are levels that we have not seen since the 1990s. Everybody saw it coming, though. All economists surveyed expected this. The Bank of Japan 9-0 unanimous in this decision. The Bank of Japan also saying the price trend is in line with target and the outlook in the second half. No real signalling on the cadence and future path of rate hikes, although it looks as if the Bank of Japan is going to remain on its cautious, slow and steady path towards tightening. We've seen a few movements in asset prices, though. The Nikkei moving higher. The yen briefly fell through 156, although we're back at 155.84 now, but the really interesting move was the 10-year yield. That's risen to above 2% now, and it's the first time we've seen it there since 2006. So we'll be waiting now for Governor Ueda's press conference, where he'll be taking that in a few hours' time. He's almost certainly going to be taking questions on what the future path of tightening is from here, particularly with an eye to what's going to happen on the fiscal stimulus side as well, and what that might mean for inflation. Elsewhere, we're seeing asset prices more broadly moving higher. The Kospi having a reasonable day, better by 0.9%. We've got the Hang Seng Index also in positive territory. We've got Indian stocks just opened a short time ago. They're also pushing higher. And I mentioned the 10-year yields just hanging on above 2% there in Japan. Right. Well, the Bank of Japan, as I mentioned, raising that interest rate to the highest level since 1995. Let's get a bit more context on how the market is digesting those moves. We're joined by our senior equities reporter, Abhishek Vishnoi. Abhishek, we did see a little pop in the Nikkei. Safe to say this wasn't completely priced in. What were markets reacting to there? Was it some of the commentary?
Well, yeah, the decision was no surprise, but it looks there is an element of position clearing here. People were overly cautious, so that's why you're seeing yen actually weakening a little bit. There is a bit of a move even in the U.S. futures. So net Nikkei also jumped, while banks, which are probably supposed to gain from a rate hike, saw some bit of profit taking. So there was an element of position clearing that was there, and then you have to keep this context in mind that this is the fourth rate hike under the current central bank governor of Japan, right? And despite that, this narrative that rate hikes are going to change, the trajectory for yen, the weakness that we have witnessed for so many eons almost, that hasn't changed. So this is more of position clearing, more of that over caution that existed before this decision came out. As you mentioned, Japanese 10-year bond futures also extended drop, bank stocks also extended drop, and Nikkei has been a bit firm.
We've also got the yield on the 10-year above 2% there, with something we haven't seen since 2006. What's the bond market telling us about what the Bank of Japan's doing about inflation?
Well, we are getting commentary which says that there is no imminent threat of more rate hikes, immediate ones, but given yields are rising and given how markets are reacting, there are obviously more rate hikes expected. More is expected to come in. Even Bank of Japan has become a lot more comfortable about its assessment of the economy, its assessment of inflation. So there may be more rate hikes that are expected to come in 2026. But like I said, 4 rate hikes have come in, but yen has not stopped weakening. So we'll have to wait and watch.
Speaking of waiting and watching, the press conference up next for Governor Ueda in a few hours' time. What sorts of questions is he likely to be taking there?
I think markets and investors are pretty much looking at what he makes of the fiscal of Japan's fiscal health, and what he makes of the yield, what kind of assessment he gives on inflation, the descents. So overall, I think these are the kind of things that people are watching out for. Let's see how yen reacts after that. This first initial move has largely been because of position clearing. So what happens during the press conference now becomes even more important from an asset price point of view.
All right, Bloomberg senior Asian equities reporter Abhishek Vishnoi there. Let's get some more on the corporate impact of higher rates and a weaker yen in Japan. Let's get to Ed Rogers now. He's CEO and CIO of Rogers Investment Advisors, an Asia-focused alternative investment, asset management and advisory group. Ed, thanks so much for joining us today. I'm hoping you've had a few minutes to parse the headlines from the Bank of Japan. I'm just wondering what stood out for you.
Good morning. Good afternoon, Paul. Thanks very much for having me on the show. I think what stands out is, again, the Bank of Japan can be very dependent on to be predictable. The directionality and the price movement here, everything is pretty much as expected. We've seen a very small move in dollar yen, as you noted. I think we punched through 156, and we're now back a little bit above that at 55.80 odd. But the Bank of Japan's been very clear in their telegraphing, I think. I think the market this is not a shock and awe sort of Bank of Japan. This is as expected, and they want you to understand that they're trying to be predictable and encouraging, if you will, of where you should be thinking about future raises and how much and when.
Yeah, top marks for communication. Everybody saw this coming, and that was clearly the intention that the BOJ had. But the question now turns to what's next. Do you expect this, let's call it a plodding cadence of rate increases to continue? When's the next one coming?
Yeah, I'm in the camp that says it's probably 6 months from now. Again, this is not a shock and awe Bank of Japan. So the things that we really should be focusing on is what is the fiscal outlook. Prime Minister Takichi, how I think has been also very declarative and very clear. The spend is real. And what does that mean? It means the inflation that is embedded, if you will continue. I think how that spills into things like wages and watching where the government is going to be allocating significant sums of money in the supplemental budget. Those are the things you want to start to think about. And we'll see the impact of that. Again, I very much like looking at the 10-year to truly understand what the market thinks about this. So going back to what more normalized numbers, one might say, on the yield side, I think that's something that people should understand what that means with regards to both fixed income and equity investment in Japan.
Now, what does it mean to you in terms of fixed income and equity investment? What's a good allocation? Where do you put money to work in Japan now?
Sure. I think given the amount of incoming calls we have from global investors that seem to have rediscovered Japan as an investment destination, I'd say the vast majority of the world of global investors is still very underexposed to Japan. So what does that mean? It means good news for Japanese equity markets, for example. On the fixed income side, it's a relatively stable place. It's not where huge fortunes are going to be made. They're not going to be massive moves. It's going to be 6 months till the next rate raise, and it more than likely will be another incremental raise. Again, no shock and awe coming there. What makes it super exciting from our point of view is that investors en masse, if you will, global investors, I think some of them are going to change from being investment tourists to more committed to the Japanese space for the medium to long term. And that implies a significant potential step up, particularly in the public equity space, where it's easiest and quickest to gain access for most of those investors.
Well, look, a weak yen has certainly seen plenty of real tourists visiting Japan. Do you expect this to attract more so-called investment tourists, as you just mentioned? How appealing are Japanese equities when the currency is so soft?
100% I agree with that statement. We're telling our investors, just go ahead and buy it at 156 yen to the dollar. That's not where we will be in 2 years' time. In 2 months, I don't know. Maybe we're going to go up to 159. Maybe we test 160. But at some point, the incremental rate raises here, coupled with, again, I think you very much want to be aware of where, to understand dollar yen, you have to understand the other half of the equation. Where is U.S. dollar? Where are U.S. rates? There's much more potential volatility, frankly, coming out of a new Fed chair and the run up to the midterm elections in the United States. So what we are telling our investors is this is just such a super cheap entry point. Go ahead and buy it. Some of it is just to park your money in yen trade, and we will eventually go back to the 140s, maybe the 130s, but it's not now, and it's not 6 months from now. It is 1 to 3 years from now. But position yourself ahead of time. Don't wait.
I want to talk a little bit more about specific equity plays in a moment, but just in terms of dollar yen and the trajectory there, do you think entry points could get even more attractive? Is your base case for more weakness, or do you think we're going to be trapped in this range for a while?
Yeah, look, I would be in much more concerned that dollar yen's going to 160 right now than going to 150 for sure. So if you want to be the perfect market timer, you could potentially wait a little bit and get a little cheaper entry access point. If you have a 1 or 2 year viewpoint, I think it's only marginal, the amount of FX gain that you have. So my advice would be allocate now rather than trying to market time the FX rate.
Okay, well, normally when we talk about equities, we often speak in terms of, the need to be selective. Do you need to be selective in Japan at the moment? Could you just buy the index or an ETF? Is there anything particular that you'd look at or anything that you'd avoid?
It truly depends on your goals. There is a beta tailwind that's undeniable that I think will continue given the interest rate scenario for both the United States and Japan. And I think if you look at just general earnings and a lot of the basic fundamental metrics that you would look at for Japanese corporations, it's a very healthy environment. So you could just buy your beta tailwind that's a cheap ETF. If you really want bang for your buck and you're really actually understanding where Japan is as far far as corporate development. Where's the Tokyo Stock Exchange? What's their role? And what's the desire for the Japanese government? Where do they see improvement in investment? They want more unicorns. They want a better venture capital ecosystem. They are in a great position to leverage, if you will, the existing 20% of Japanese GDP, which is based on manufacturing. How do you get the most out of that? How do you become the what's the leverage point, if you will, for the light manufacturing that the United States gave up on 30 years ago, that China took over? And that because the geopolitical realities, Japan is now front and center. One of the reasons why Japan is front and center with so many global investors is the geopolitical situation. It's not just the metrics on the economy. It's the metrics, if you will, on geopolitical risk and the need for Japan, and I say need very specifically, to become, if you will, the vital industrial engine of manufacturing for the United States and many allied countries, such as NATO, formal military allies. But let's talk about economic security, which would include AUKUS and from Australia to the Philippines, all the way up to South Korea. Japan should be the engine of growth for many, many, many sectors that are in the manufacturing space, where they have a leverageable capability that simply does not exist, frankly, in the United States right now.
Yeah, Japan also one of those many countries that are currently building out chip manufacturing capabilities also. Do you see anything in the tech and the AI space that stands out for you in particular, where you could see some outsized gains?
Absolutely. On chips, I think the robotics space, I think certain parts of the energy space. Look, Japan is very focused, and people should be paying a lot of attention to Prime Minister Takichi. They should be what she says and what she's focused on. I think there's a much more unified government stance, if you will, in Japan about the need to understand the goals and what's the role of METI, what's the role of Ministry of Finance, what's the role of private, if you will, businesses, public businesses, private space, meaning venture capital. I think there is a really, really healthy ecosystem developing here for allocation of risk capital. And if you believe that, that's why if you want alpha and you want outsized returns, you're not thinking about buying a Japanese ETF. You're thinking about what are the Japanese companies that are going to potentially be lined up to IPO and be a unicorn IPO over the next 3 to 5 years. That's the most interesting space in Japan for us right now.
Ed, you've laid out a very bullish case for Japan, but are there any sectors of the economy that you feel may lag? And I'm thinking, we're seeing inflation, although, for many parts of the world, 3% would not be considered outrageous, but for Japan, it's at levels that many consumers are simply not used to. What's your attitude towards consumer stocks and other sectors of the economy that might be feeling the pain from unfamiliar inflation?
And 30 years of deflation, to be honest, has left what is normal. Again, if you're trying to compare apples to apples, inflation, Japan versus other G7 or G20, that's a very challenging, frankly, comparison, because the Japanese consumer has been used to the price of eggs being the same for 30 years, and then it goes up 5 times in the course of 16 months, 17, 18 months. That is a cause for concern potentially, I think, as far as political ramifications, as we see playing out in the United States, the affordability discussion and how that will impact midterms. Our view, the Rogers I view, is that Japan is far more politically stable. The goal of achieving this inflation, and the reason why the Japanese Bank of Japan has been very slow and steady on their interest rate increases, is it kind of suits everybody to see this ongoing inflation in Japan. It's meeting a goal that is 30 years old to try and create some sustainable inflation. And if it goes a little bit over for a little bit longer, that's okay. No one here is going to panic about that.
Ed, before we leave you, I'm just curious, if you were sitting in that press conference a little later on today with Governor Ueda, what would you ask him?
I would say what might change your view on that slow and steady, if you will, outlook to something that requires you to be much more proactive. Can you give us any guidance, perhaps, on areas of concern, a number that inflation would hit that might really trigger, if you will, a more than an incrementalist response, because that is possible. Our view is that there could be a possible surprises to the upside on that inflation number going forward.
All right, Ed Rogers, great to talk to you. Ed is CEO and CIO of Rogers Investment Advisors. Right, let's get you back to Mumbai. ICICI Prudential Asset Management set for its official start of trading in a few minutes. Shares are set to jump 20% according to pre-market figures. We're going to have a little bit more on this in our India focus later on this hour. So that ICICI Prudential priced at 2,165 rupees at the high end. And we are anticipating quite the pop when that gets going. All right, we have plenty more ahead. This is Bloomberg.
I have one aim, to get an answer for the question, what will the United States of America do if Russia comes with aggression again? What these security guarantees will do? How will it work out? What will all partners do? How, with what power they will stop Moscow?
That's Ukrainian President Volodymyr Zelensky speaking in Brussels as European leaders seek a deal on the use of frozen assets to fund a loan for Kyiv. Well, Bloomberg's been told that the US and Ukraine's European allies have put together a plan for security around any peace deal with Russia. Sources say an 800,000-member Ukrainian army would be the first line of deterrence. The US would provide intelligence, and a European coalition would station troops behind the front lines. Ukraine's president says Washington will make the plan legally binding with a vote in Congress. Well, EU leaders meeting in Brussels have agreed to a $106 billion loan to Ukraine. The funding will be delivered using joint debt rather than frozen Russian central bank assets. Let's get to Bloomberg managing editor Jill Desis now. So, Jill, tell us a little bit more about the details, the structure of this loan, and why weren't frozen Russian assets used?
Yeah, I mean, I think that at this point, Paul, the really important thing to kind of remember here is that this is just, all in the context of these ongoing negotiations that, we're really looking at in terms of whether or not there can be this end to the war in Ukraine. I think, again, at this point, you're still looking at, this really, really sort of complicated negotiation structure. Obviously, this comes just a few days after we had heard of, these negotiations involving the U.S. Trying to reach some kind of a peace deal, maybe before the end of the year, potentially in January. But as you're, sort of seeing from some of those leaders in the EU, they're trying to create some kind of a structure where they can actually get to the point where they're bringing Putin back to the negotiation table. There's still a lot of unanswered questions about what exactly, those potential deals sort of ultimately look like, and then, whether they can, ultimately reach something that sees some kind of a broader sort of peace structure here.
Yeah, how is this loan going to strengthen Kyiv's hand?
Well, I think at this point, when you're talking about, the potential for those frozen Russian assets, you're really looking for a place that, creates something that's at least a favorable environment where you can actually have those discussions. Ultimately, what remains at issue when it comes to those ongoing broader negotiations, when you're talking about the war as, sort of those territorial concerns, what Kyiv is obviously looking for is, to, not give up those territorial gains. That's something that's been a real sticking point with Putin in Russia over the last many, many months, and that sort of held up a lot of those ongoing negotiations. Whether this actually is something that sort of breaks some of that progress, I think we'll have to see. But obviously, you're seeing some of those fairly positive comments from the European leaders.
So obviously, this is a loan, the implication being it's going to have to be paid back. What are the conditions for Ukraine repaying this money?
Yeah, I mean, I think that, look, Paul, at this point, we're still, sort of seeking through some of these details, and we're looking sort of how that really sort of fits into some of those bigger, picture issues here.
All right, Bloomberg Managing Editor Jill Deesis there. Here are some of the other top stories that we're following. Chinese Foreign Minister Wang Yi has expressed support for Venezuela after President Trump's oil tanker blockade. Wang told his Venezuelan counterpart Beijing opposes unilateral bullying and supports countries safeguarding their sovereignty. The comments come less than a day after Trump's latest escalation in the U.S. campaign to oust Venezuela's leader, Nicolas Maduro. U.S. police say a man suspected over last weekend's shooting at Brown University has been found dead at a storage facility in New Hampshire after taking his own life. Earlier, authorities identified the 48-year-old former Brown student as a person of interest in both the university killings and the later murder of an MIT professor in the Boston area. Saturday's attack at the Ivy League school in the state of Rhode Island killed 2 people and wounded 9. Right, let's take a look at how benchmarks across the Asia-Pacific are tracking at the moment. Of course, the big news of the hour, Japan cutting its... increasing the base rate for rates in Japan by 25 basis points up to 0.75%. We now got rates in Japan at the highest level we've seen in 30 years. The Nikkei giving up some of the gains that we saw in the wake of that decision, now only higher by about 1%. We were initially better by about 1.5%. But the Bank of Japan saying that the price trend is going to be in line with target in the second half. We saw the 10-year yield hitting at 2% for the first time since 2006. But we're seeing broad-based gains across the Asia-Pacific today. Also after that encouraging inflation print that we got out of the US, even though there's a bit of data missing due to the US shutdown. We have plenty more ahead. This is Bloomberg. Makes it official. ICICI Prudential AMC making its debut in Mumbai after plenty of pomp and ceremony in the build-up there. And already, as anticipated, we're seeing a little bit of a pop in those shares, moving higher to the tune of about 22% there. Well, the company did raise $1.2 billion in its share offering ahead of potentially the last major Indian listing this year. Not many days left in the year. For more, let's get to Asia Equities reporter Ashutosh Joshi joining us on the line from Mumbai. So, Ashutosh, that offering well oversubscribed. A lot of optimism behind this. What was driving that?
Absolutely. The IPO was huge in demand. We saw strong participation from institutional investors. In fact, the portion reserved for institutional investors was subscribed 124 times. It's some of big backer names included BlackRock as well as Government of Singapore and India's Life Insurance Corporation was also among big investors. This IPO will be the final $1 billion IPO this year and takes India's IPO mop-up for the year past $21 billion, a successive record for second year. And there is hope that for the next year we have equally strong pipeline. What's interesting about ICICI Prudential is that it is seen as a play on India's mutual fund industry. The company is already India's second biggest money manager, having more than $120 billion of assets. 2/3 of that coming from equities, and it continues to benefit from consistent household inflows into stocks through mutual funds. India has been receiving over $3 billion per month from dedicated mutual fund investment plans, and that makes ICICI Prudential attractive to investors.
So, Ashutosh, you mentioned there the pipeline for 2026. Can you tell us what this successful listing today means for the sort of enthusiasm that we have around the IPO environment in India more broadly at the moment?
Sure. More than 60 IPOs have already been approved by Indian regulator, and big names that are expected to take place include next year include a similar money manager unit operated by State Bank of India, the country's top lender, which is also exploring IPO for its mutual fund unit. Apart from that, we are expecting the country's biggest stock exchange, the National Stock Exchange, is among names that could explore IPO for the next year. With this, the pipeline for 2026 looks pretty strong.
All right, Asia Equities reporter Ashutosh Joshi there in Mumbai. Let's take a look at how Indian markets are performing at the moment. Obviously, a very positive IPO there for ICICI Prudential. And the mood overall, one of optimism today. We've got the Sensex pushing higher now by about 2/3%. All of the major indexes in India higher, although we're seeing some risk-on sentiment, modestly so, across the entire region today. Take a look at the rupee, though. It's back below 90. Oh, there it is, back above 90. But it has strengthened after the intervention that we've seen from the RBI this week. So it appears to have worked in the short term at least. However, risks do remain to the currency. But the IPO right now, the Indian rupee right now, just parked above 90 there. So let's talk a little bit more about that stage back, that comeback. It has come after weeks of softness over the last few sessions. The currency has gained about 1% against the dollar, reversing away from that record low of 91 that we saw earlier this week. Now, the RBI is believed to have stepped in pretty aggressively, selling dollars and buying bonds worth 500 billion rupees to calm the markets. And that intervention sends a clear signal to speculators betting on further weakness. Still, analysts warn the pressure is not over. Foreign outflows and trade uncertainty keep the currency vulnerable. For more on the rupee's moves, let's get to Mumbai and Bloomberg News senior editor Menika Doshi. So, Menika, tell us, on the wake of that intervention we saw from the RBI, can we say that this battle is won yet, or is there potentially some further rupee weakness in store?
Well, far from one, Paul. As you pointed out, that intervention earlier this week has helped, sort of the rupee recover from 91 levels, which was a fresh record low, to, as you just pointed out, 90 levels. But most economists and currency experts I speak to say that that relief is going to be short-lived. Now, the fundamental problem or the reason for the rupee's weakness is capital outflows from the country. And then, of course, the absence of an India-US trade deal has added further pressure, even if you call it sentimental pressure. Now calls for further weakening in the rupee range from between 93 to 95 levels for the first part of 2026. And the key question, Paul, is what impact will this have on the country's growth and its economy? Now, to answer that, I'm joined this morning by Somnath Mukherjee, CIO and Senior Managing Partner at ASK Private Wealth. And also joining us is Anubhuti Sahay. She's Head of India Economic Research at Standard Chartered Bank. So Anubhuti, Somnath, thanks very much for being on Bloomberg. Anubhuti, let's start with you. What do you make of the rupee's underperformance this year, Asia's worst performing currency, despite the relief we've seen this week?
I think what you highlighted at the beginning is, lays out what drives the rupee weakness very nicely. At the core of the problem, I would break it down in terms of three factors, which is driving rupee weakness, and probably these three factors will remain rupee weakness or will keep rupee under pressure going into 2026. Our forecast is at 93 by end of December 26. And as I mentioned, there are three factors for it. One, weakness in capital flows. If you look at last year, India's capital inflows or net capital inflows were the weakest since global financial crisis. It improved a little bit in this financial year, but again, it's one of the weakest in 1.5 decades. And next year, again, we don't think it will improve to what we saw a decade back also. And that is primarily led by very, very soft FDI inflows. And till the time we really get a visibility of FDI inflows turning around in a significant manner and in a sustainable way, I think this weakness in rupee will reflect or will try to reflect the weaker external inflows. And that theme would remain very much dominant. Second, increased tolerance at the RBI level for a weaker rupee, because they are trying to realign rupee levels with a weaker capital inflow story. They still have very healthy reserve cover or import cover, close to 10 months, even if you adjust it for forwards book. But as visibility on collecting back lost reserves or building FX reserves higher is very low, it is important that rupee is allowed to be a shock absorber while ensuring that external sector remains resilient on a medium-term basis. Third, I think even if you get some inflows next year, a pullback looks very unlikely because RBI will use every single opportunity to rebuild FX reserves, especially as the global environment remains highly uncertain. So I think what we have seen over the last 1.5 months would remain dominant going into 2026 too.
A quick follow-up, Anubhuti. What level do you expect the RBI's intervention to be the most at? You're saying 93. Are you expecting the rupee to achieve that in the first 3, 4, 5, 6 months of the year?
93 is for December 2026, Menika. In the first quarter, that is in March quarter, we are expecting a little bit of a balance of payment surplus. Current account has a seasonality, and that possibly it will turn into in the positive terrain. Capital inflows might also see some respite, and that should support rupee, and probably RBI's intervention might not be needed as strongly. But going forward, our view is that RBI's FX intervention strategy will remain more towards smoothening the move in rupee rather than defending a particular level. It's very difficult to say at what level they will come very aggressively, but I think the broader message which we got even from RBI governor's interview, that 3 to 3.5% appreciation on an annual basis is trend in rupee, I think we'll need to take that as the broader guiding light going into 2026.
All right, the key question is capital flows, Somnath. Not just FDIs, Anubhuti pointed out, but FPI, over $18 billion leaving the country this year. What's going to change that next year? What's your outlook?
Yeah, so a couple of things on that. I think between FPI and FDI, and some of it is sort of fungible. The bigger reason why we've seen weaker flows this year, or net outflows this year, has been that the buoyant and very deep Indian capital markets, and we just saw a very large listing just before this program started, has meant that it has given the opportunity to a whole range of larger strategic investors, including the largest of them being global private equity, take money off the table and return money to their LPs. And that's been an overriding theme with especially private equity globally. The LPs have been demanding DPIs or distributions rather than merely paper IRRs. Sure. Outside of the US, India is one of the very few markets that offers the depth and liquidity that allows large-scale exits for investors. And that's something that's been taken very aggressively over the last 2-3 years by several types of strategic investors. So that's been the big reason. Will that reverse next year? I think to a certain extent what will reverse is that the gross inflows are likely to be higher, driven by a couple of things. One, valuations are somewhat better than what they were 12 months ago. Second, like all cycles, we went through a bit of a down cycle into 2025. We are looking like, given all the high frequency indicators, towards a reversal of that cycle. So there is likely to be earnings upgrades going on from the next quarter all the way. And that's going to attract more money. And last but not the least is a global coordinated easing of sorts of central banks, which should take yields down from the levels we have seen this year.
It seems to be coming to an end now, isn't it?
It's all data dependent, but from all indicators, there is very little to show that there is merit in keeping rates high. Look at India. Our real interest rates are amongst the highest in the world. Our nominal GDP growth today, the spread between nominal growth and 10-year GSEC is one of the lowest we have seen in history. actually that effectively means that it is less attractive for a strategic investor to invest the money into productive assets simply because the spreads are not there. So there is actually not a massive amount of incentive for producers or for manufacturers to set up new capacity. And that's going to drive policy making this year. And that's where the rupee weakening actually is a good outcome today, because it acts as a shock absorber. It leaves monetary and fiscal policy alone to focus on what is truly important, which is growth in jobs, which is what we expect the central bank to do for 2026. Focus on reviving growth. And by reviving growth, I mean nominal growth. Right now, we have a really healthy real growth on the macro side, but reviving growth across the board, and that should bring back the headline gross inflows from foreigners as well.
All right, so you're talking about the advantages of a weakening rupee. Anubhuti, what do you see as the overall macroeconomic impact of a weakening currency, both from the import side of point of view, though we've been lucky that crude has been manageable, but also from an export competitiveness point of view?
So I'll answer your second question first. From export competitiveness perspective, rupee weakness would help, no doubt about it. But I think we also have to remain cognizant of the fact that Indian exports or exporters are price takers rather than price makers. Plus, we also have this whole uncertainty around US-India trade deal. So it helps, but I would say it's an incremental support for exporters rather than a massive support. Second part, how does it impact import? As you very rightly said, I think it is definitely not a positive from import perspective. But at the same time, given that commodity prices across the world remains extremely low, our sense is that the impact is likely to be limited. You spoke about crude oil prices, and it's very interesting to see that even though crude oil prices have corrected by $10 to $12, if we compare it to the start of the financial year, our oil deficit has remained pretty strong. I mean, deficit is actually marginally higher than what we saw last year at the same time. And that's because we are importing a lot more. So I think there are a lot of factors which are at play. One, that we are growing at a faster pace than rest of the world. Second, that select commodities like gold are going through very, very high prices. So, barring gold, I think for rest of the commodity space, low prices should help to counter off any large impact from a weaker rupee.
All right, so how does this set us up, let's say, for the government's key agenda points in, 2026 or FY27, combining both here? So Somnath, assuming no deal is signed, because we've been hoping for this to happen over the last several weeks, it hasn't. Assuming no deal is signed, what will be the key priorities next year? We're just a month away from the union budget.
Right. No, actually, it seems that the ceteris paribus condition, the use that expression used by economists too often, it doesn't look like either government is in a hurry to do a deal, whether it's the US or India. We've seen very bullish statements, but none of those look like that either side is bending over backwards to get a deal done. I think we should take it as a positive news when it comes, rather than trying to price in the fact that it will come in a short period of time, which is where the depreciation of the rupee is actually a good portend, because albeit imperfect, it's still a defense against losing competitiveness in the export market. Our trade-weighted tariff today is 2x that of any other relevant peer country on the export side that we have. And hence, the government can therefore focus very sharply on ensuring that domestic levers of growth, which would primarily be the engines of growth because exports are tough, do come into play, and they focus on that.
Quickly, when you say domestic levers of growth, what does that mean?
It has to be consumption. So consumption is 60-65%.
Well, we've already done the tax cuts this year.
We've done the tax cuts. More needs to be done. Whether it is in terms of...
We're a country consolidating its fisc. We've done the tax cuts. We have limited spending power. What can they do?
First of all, I think while we have done a great job in terms of consolidating the fisc, ideally it will be great if the government let it loose a little bit in 2026, because we've seen the impact of a tightening fisc for a good 3-4 years, since the COVID peak. And it's, at this current moment, doesn't seem to be the most obvious policy choice to boost growth. Let the currency weaken, let that be the shock absorber while inflation is still low, let the fisc loosen a little bit.
That's the CIO speaking. Let's ask the economist. Anubhuti, what do you make of a potential shift in fiscal consolidation, though the government has offered no evidence of that so far? And then quickly, your key things to watch for in 2026.
Sure. So I think I have a disagreement here with Somnath when it comes to loosening the fiscal policy. I completely agree that fiscal policy has been consolidating since COVID years. But COVID was a crisis period, and we really cannot, as a country, run a double-digit fiscal deficit on a year-on-year basis, or at 7%. Even today, we are running a fiscal deficit of 7% of GDP, combined, central and state put together. And that's high by any standards. And the second point is that the government, as well as the RBI, have pushed a lot of counter-cyclical measures in a very short span of time. I think the time is now to focus more on structural issues if India wants to avoid running in circles again and again. It's important that structural issues, whether it is about ease of doing business, whether it is about tax consistency, those are addressed. Because if you look at the overall growth inflation dynamics, they make India look like in a sweet spot, but have they really resulted in job creation? Right. Have they really resulted in attracting massive amount of FDI inflow? So there is far more structural issue rather than just focusing on counter-cyclical measures. Counter-cyclical measures can complement, but cannot be a remedy for what India has been going through over the last couple of years.
All right, let's see if it'll be a year of heavy lifting. Anubhuti, Somnath, thank you very much for joining us. We're heading to a break, but stay tuned. More on Bloomberg Television.
Indian lawmakers have passed a bill to open up the country's nuclear industry to private investment that could be worth more than $200 billion. It's part of government efforts to support the economy and wean itself off carbon. For more, let's get back to Stephen Stapczynski, who leads our Asia energy coverage out of Singapore. So, Stephen, can you tell us a little bit more about the details of these law changes and how they're going to alter the current state of nuclear power generation in India?
Sure. There's two major pieces of this. One is it gets rid of the decades-old nuclear operating monopoly within India. So it allows other companies to own, operate, build nuclear reactors. That allows others to bring money in and to take on those projects. The second thing is it also gets rid of the liability laws, or lessens them for the technology providers. So in 2010, India introduced basically rules that made technology providers, that's like Westinghouse or any company from Europe or China that sells the technology to India, they would be liable in the case of an accident, like a nuclear meltdown or any other operational issue. And that would open them up for litigation and other sorts of penalties. And that held up a lot of import deals between India and foreign suppliers. A lot of projects stalled because of that, and so reducing that liability rule and also essentially opening up the sector, the idea is to pave the way for projects to move forward. Now, of course, there are a lot of questions that remain. These are not cheap projects. These are projects that cost billions of dollars. It requires requires banks to get on board. It requires towns and companies to get involved. So while this is one of the barriers, there are a number of other things that need to kind of get cleared before we really see projects ramp up.
Yeah, Stephen, there's only about 7 nuclear power plants in India at the moment. I mean, realistically speaking, where are we likely to see those numbers head, and is it going to put a dent in India's carbon footprint?
So there are, I guess you can look at it 2 ways. There is what the government wants to do, which is increase capacity 11-fold through 2047. That's going to cost over $200 billion, and it would be one of the largest build-outs in nuclear power, second only to what China is in the middle of doing at the moment. Now, where do they actually land? That's a big question. I don't have the crystal ball, but I think it is pretty clear that if they are able to drastically increase the amount of nuclear reactors that they have, that is every reactor is one less plant that's needed for coal. India is very much dependent on coal. Most of its power mix is generated by coal, and it's very polluting. It is the most polluting fossil fuel. So by rapidly increasing, if they're able to increase 11-fold by 2047 over the next 2 decades, then you are going to see less of a dependence on that fossil fuel.
All right, Stephen, we're out of time. Thanks for joining us. Stephen Stepczynski there leads our Asia energy coverage in Singapore. Before we go, a look at our guests for next Monday. Harvard Kennedy School Senior Fellow Andrew Collier is going to join us to weigh on the outlook for property in China. Also, JLL will share their latest research on India's real estate investment landscape. That's it for Insight. This is Bloomberg.